This is Ejaz Khan, and in our today's video, we'll be discussing CVP analysis. Well, what is CVP analysis? CVP analysis is basically an analysis which analyzes the relationship between cost, volume, and profit. And this analysis is basically done to plan different activity levels of the business. Let's try to understand this with the help of an example. Let's say we are running a burger shop and we sell each burger for $10. Now definitely when we will be selling this burger for $10, it will also be costing us. So let's say the bun costs $1 for every burger. Other material costs us $2, and the company pays its chef $1 per burger. It means that each burger is going to cost us $4. This burger is sold at $10 per unit, and it costs us $4, which means that we'll be saving $6 contribution from every burger. If we needed to find out the contribution to sales ratio, then we have to divide 6 by the price, which is 10, in order to find out how much we are saving in terms of percentage. So the contribution is 60% of the price. It is called CS ratio. Now, definitely, we will have a shop and we have to pay the rent for the shop. Let's suppose we are paying $3,000 for this shop every period. So, what will happen if we don't sell any burger? So, if we don't sell any burger, we won't be preparing any burger. So, if you're not preparing any burger, we don't have to buy the buns, we don't have to buy the materials, so that $4 won't be spent. On the other hand, we won't be able to earn that $10 as well. So we won't be spending $4, we won't be earning any $10. But we still have to pay the rent, which is $3,000. And if we don't sell any burger, the whole of the $3,000 will be paid out of our pockets, and that will be the loss to the business. So at zero activity level, there will be a loss of $3,000. So definitely we won't be looking for any loss. We will be trying not to make any loss from our business. So how many units or how many burgers we will be selling if we really want to come out of this loss? So you see that we save $6 from each burger and the rent is $3,000. How many burgers we will be needing in order to generate these $3,000 so that we can cover the fixed cost? So we need 500 burgers to cover our fixed cost, which is $3,000. And if we are able to sell these 500 burgers, we'll be able to generate $3,000 and we won't be making any loss as we will be covering all of our costs. And when we reach to a point where we are not making any profit or any loss, that point is called break-even point. So the break-even point of our business will be 500 burgers, and this will be calculated by dividing total fixed cost with the total contribution per unit. Similarly, if we want to know how much revenue we will be generating from this activity level, which is 500 burgers, then we have to multiply 500 by the price, which is 10, and it will give us a total of $5,000, which means that we will be generating $5,000 from selling 500 burgers, and these $500 $5,000 will be called break-even sales revenue. Alternatively, we can also calculate the break-even sales revenue by dividing our total fixed cost, which is $3,000, by the CS ratio, which was 60%, to find out how much we need to generate, how much sales revenue we should be generating in order to be at break-even. So it gives us the same $5,000, the break-even point in revenue. So it will be calculated by dividing total fixed cost by the CS ratio. Now, definitely, the businesses will always look for profits. So do we. So we're looking for a profit of $1,200. Now we want to know how many units or how many burgers we should be selling so that we are able to earn a profit of $1,200. So we were generating a contribution of $6 from each burger that we sell. We have a fixed cost of $3,000, but this time we don't want to generate only $3,000 of contribution, because if we do so, we'll be at break even. So we'll definitely be looking for a contribution higher than $3,000. Since we want to generate a profit of $1,200, so we need to generate a total contribution of $3,000 to cover the fixed cost plus $1,200 to earn $1,200 target profit. So the total contribution that we'll be looking for will be the sum of $3,000 and $1,200, which will be $4,200. And we will divide it by the per unit contribution to see how many burgers we need to sell in order to generate a contribution of $4,200. So it will be 700 burgers. And that's called target profit sale units. That is, if we want to earn a profit of $1,200, we need to sell 700 burgers. In the previous example, in the previous slide, sorry, we were looking for the break even. So we had to sell 500 units to be at break even. But now we want to earn a profit of $1,200. Therefore, we have to sell 700 burgers in order to earn that profit of $1,200. So the formula for calculating target profit sale units will be the total fixed cost plus the target profit divided by the contribution per unit. So if we need to find out the revenue that we need to generate in order to earn this $1,200 profit, the formula will be the total fixed cost plus the target profit divided by the CS ratio, which is 60%, and it will give us an answer of $7,000, which means that we have to generate a revenue of $7,000 if we want to earn a profit of $1,200. So that's called target profit sales revenue. So it is calculated by dividing the sum of total fixed cost and total profit by the CS ratio. Now let's suppose that the company is selling 700 units and generating $7,000 revenue. And we know that at this level the company will be making a profit of $1,200. But if we need to find out by how much the sales revenue will fall so that the company is still not making any loss, we know that at 500 units the company will be making no profit, no loss, whereas at 700 units it will be making a profit of $1,200. So from a level of $700 it can go down to 500 units, that is a reduction of 200 units. So if the company's sales level fall by 200 units, it will still be at no profit and no loss state. So that 200 units is basically the margin of safety of the company, which is calculated by subtracting break-even sales from budgeted sales to see the margin. And if we need to find out the margin of safety in revenue, we can simply multiply these 200 units with the price, which is 10. And if we multiply the 200 with 10, it will give us the margin of safety revenue, which is $2,000. Alternatively, we can Find out the margin of safety revenue by subtracting the break-even sales revenue, which was $5,000, from the target profit or the budgeted sales revenue, which was $7,000, and we'll get the same answer, $2,000. Thank you for watching Easy Study. For more videos, kindly subscribe the channel.